So, hello, and a massive hello to everybody. How we all doing? Rocking and rolling in a free world. Here we go, here we go, here we go. No trade calls, recommendations, or response for their own stuff. We're here for educational purposes only. So, guys, what's going on? A little bit of an impromptu session. It's been a while since we did one of these. How's sound? So again, nothing spectacular going on. Action's been a little bit boring, even though there have been opportunities across the board. So again, as usual, just trying to pay it forward. We'll run for about 20 minutes and just take any questions anybody may have. Oh yeah, sure. That's the chart we had. Well, question is on the BND chart I posted the other day on the blog. Well, again, basically one of the things we discussed was how, in our view, and again, this goes also in line with the 2020 themes, even though the long bond is one of the themes maybe which is extremely crowded, right? And it could definitely go very, very long. It seems to be for now, unless something changes, one of the nicest trades out there. And here, what we'd structured here, you can see a long setup here with very tight risk, right? For a nice risk reward, and even more if we continue to grind higher, right? So the base case here was that once we broke outside of this pattern, right? You see we broke outside and then we stabilized here. We've got all the moving averages coming in to support and off to the races. And as long as this break holds, right, you've got very nice asymmetry to play for a move back into these highs, right? And it doesn't mean it has to stop there. I know some people think it sounds like funny land if you're talking about things moving even higher, but as you've got to go with the flow, right? You've got to go with the setups, you've got to go with what prices is telling you. And this is a nice example of a breakout trade, which, to us makes an awful lot of sense. And here, right, as we've been looking at, a lot of people were getting very excited when the 10-year was moving back into closer to this 2. And we said, this is just a corrective move as far as we're concerned. And there's really no reason to panic unless we see repeated closes above the 2 mark. And you see right here, the 200's coming down, it's holding. And now, especially if we can break down here, don't be surprised if this comes in very quickly, right? You can look at what happened with Bunds and across the board. When we started to get towards that 0 mark, everybody thought it's impossible. But then that last leg, right, from the say 1.5 or 1 to 0 came extremely quickly, right? So it doesn't mean that it has to work the same way, but when you have a nice asymmetric opportunity to try and take advantage of that, right? It makes sense to us, at least, especially when, the central banks have been coming out, and especially Powell saying that, they're not going to raise rates, right? They even changed their tune, talking about the fact that even if inflation does pick up, which we suspect it very well may, right? But even though it does, unless it's really goes crazy, they're willing to let it run hot, etc. So here, the bet has to be to try and continue to play for these bonds to play higher, right? And we've had a decent move here after that correction. So far so good. And especially if you're in a position where you're, break even or better on the trade, it clearly makes sense to continue to stick with that trade, okay? Yeah, I mean, in terms of stocks, right? Well, what we've been trading a lot more, we've been focused on shorts on the Russells. As long as stocks are making you highs, there's very little edge in trying to stay aggressively short, especially something like NASDAQ, etc. You want to wait for some kind of weakness to come in, right? And we've seen these moves before, right? Look at, was it January 2018, I think, we had that aggressive melt up and then things came back. These kind of moves, low liquidity move, aggressive ramps in the overnight session, usually always tend to finish in the same way, right? The markets gives them back in a fraction of the time it took to pump or get there, but you don't know when that will happen. So there's very little edge in trying to continue to short strength, right? A lot of people believe that new all-time highs are bearish, you should short. All-time highs are bullish by definition, right? You'll see a lot of buyers coming in, people trying to push it higher, stops getting hit. So you don't sell something that continues to make all-time highs. You want to sell something that is weaker, right? You'd prefer, in this context, you prefer to sell the weakest or buy the strongest, right? If you're looking to buy. And here, that's why, even though for all the reasons we've discussed in the sessions, what we've been discussing on the blog, we feel this latest ramp up in equities, the market will give it up in a fraction of the time it took to get there, and we're looking for a 5 to 10% correction. Even if ultimately we're going to go higher, we much rather trade that by shorting the weakest of the indices rather than trying to stay stubbornly short the longest, like the Nasdaq, and get killed, right? So here, our expression of the trade of the short on indices is, so far we've been focusing on the Russell, so we're short the Russell, and so far it's been working, right? You see here that we've had this nice reversal here as we tried to stall ahead of the 1700 level. Then we came back up, clipped those stops and couldn't get any traction. And at this point, you have an interesting level to try and get short, right? Because you can either get short against this high if you want to keep it tight, or you can try and build a short and stay short against the all-time highs, right? And to us, this makes a lot more sense. So we're still expressing that trade by shorts on our view of the correction, by shorts on the Russell rather than on trying to fight the Nasdaq, right? In terms of the ES, our base case hasn't really changed here. We're looking for this to potentially grind higher, but we expect it to stall inside this this range here, which 3404 is to the upside, and we'll have to see. What you have to keep in mind is here we're going into a phase where we've got all the central banks on deck. So starting today, we had BOC, we're going to have ECB, FOMC, so the Fed with the FOMC, the BOE, etc. And we're going to finish off with the earnings with all the big tech names reporting. So, we like to have some short exposure, especially on the Russell because it's the weakest, but we don't want to be all in short ahead of all the central banks and ahead of Apple, Amazon, and all these earnings. We do feel that these next 2 weeks have the potential to really set the stage for the next quarter or so, or again, to give us this 5 to 10% move. So we're very, very focused on action, but we really not fans of trying to sell into strength. So, even here intraday on the ES today, tactically, it could be interesting if you want to be aggressive to short off these highs. As you see, you've got a little bit of a failure here. So as long as this holds, you wouldn't be surprised to see this try and come back down to weekly lows and possibly all the way lower. But again, it's still fairly strong. But the message is, we'd much rather be shorting weakness than shorting strength. The action on the DAX is interesting today, right? Because you see how it continues to struggle at those highs. If you look at it from a weekly perspective, you can see this area. It's failed a lot in this zone, and it will be very interesting to see if we close negative on the day or not, and if this can get a little bit traction. So the DAX is also fairly interesting here. Can I look at USD? Yeah, sure. Keep in mind, we've still got Polos. Polos has to speak, right? So we've got the press conference. So it's really tricky to say ahead of the press conference. Here, this was a trade from our 2020 outlook, right? And our base case, well, again, just quickly, you had beautiful opportunity to try and get long here at the beginning of the year with very, very tight stops from a move back higher. But our base case has continued to be both from, for fundamental reasons and some bigger cycle work that ultimately everybody's looking for this to tank. And we've been talking about the fact since last year, and especially the 2020 outlook, that we feel that the surprise here on CAD could be for a rip higher, much higher. So we'll have to see how this plays out. But our initial case was Jason, right? Yeah, Jason. Our initial case was that we had very, very tight asymmetry here to play for a move back into this 31 and possibly back into the 132, right? As long as those levels don't get breached, this is still fairly heavy, right? You can roll back and you can see, right? You can make a lot of arguments that any kind of retracement higher is still, if you're bearish, is still a sell into this descending trend line, into all these moving averages, right? So we think that the real tell will be now how we trade through the press conference, and again, obviously what happens on crude, but not as much as it used to, and what happens on equities. But we think that the far bigger surprise here, especially if we can stabilize and close above that 132 and tackle this 200 DMA, is the big surprise, is to see a lot of people get stopped out and to see this back towards the 136s quicker than people expected. I mean, at this point, is it a done deal? Is it a slam dunk? Absolutely not. But since the beginning of the year, you had so much opportunities to build a nice position here with a nice tight stop, that at this point, anything more is gravy. But I think it was particularly interesting when it traded there. Sure. Yeah, Euro, I mean, we've got the ECB, so it's going to be interesting to see what happens. Keep in mind that it's not uncommon to see the Euro trade heavy into the ECB, post ECB, and then base a little bit afterwards. Here, in terms of the chart, not much has changed. We're still stuck here, but in the midst of all the things that are happening, it's been holding on remarkably well, right? A lot of people will be talking about January effect in Euro. Euro tends to put in a swing high or swing low in January, sure, but we're a lot more focused on the levels. And here, what we're saying is that, especially here as we came into the new year, 112 to 110 is a massive chop zone. And to us, irrespective of the fact that you could make money to the upside, you can make money to the downside, you could be scalping this range, as far as we're concerned, nothing matters. And we get no additional information as long as we're trading inside this zone. Okay, so above 112, then we expect 114 to potentially come very, very quickly. Below 110, we expect the market to try and clip stops and try and trigger sub 109 very, very quickly. But as long as we're trading inside this area, what we'd say is much to do about nothing. Our preferred assumption so far, again, unless we get a day close below this 110, is to use any weakness into ECB and post ECB into next week to build longs and work on longs for this to set some kind of a swing low this month and then move back higher towards the 112, 114. And that really hasn't changed that much as we're concerned. That's still our base case assumption. Sure. Anything else anybody wants to look at? Yeah, well, that's going to fall in line with the DXY, right? And again, look at the way the DXY here. What we're getting is a nice little correction, as we said, DXY similar to Euro. Unless we get a move outside of this choppy area, it's just wheeling and dealing, right? January flows tend to be a little funky. You've got a lot of hedges being put on, taken off, a lot of people positioning for the year, et cetera, et cetera. It's just a lot of corporate demand. It's just, it can be a funky month, right? So here, our base case is still day closes above the 98, then it could catch a lot of people off guard, and you would expect that 199 to come quick. A day closes below this 97, and we would expect that 96 to come into play very quickly, right? Below 96, uber bearish and we expect it to accelerate exponentially, the biggest thing that could catch most people off guard and essentially wreck the world really is if we ever get it back above the 100. But right now, our base case still hasn't changed, is this move is corrective, even though it's trying to play higher. And we're looking for this area similar, again, as you would expect, similar to Euro, to find tight opportunities to try and get back on the short bandwagon if you want, right? And express that through a number of different currency pairs. Yeah, I mean, crude here, yeah, well, I mean, a lot of people discussing what's happening with China here with the outbreak, etc. Remember when SARS happened, crude got sold off quite aggressively, right? And we talked about this in the weekly webinar. I think most people attribute that to this, less travel, aviation stock, what do you call them? Aviation stocks or whatever, plane stocks, whatever you want to call them, they get whacked, and crude tends to get whacked. Here it was trying to hold the 50 back of this move A to B here, right? It was trying to hold, and now with this headlines hitting the wire, it's starting to sell a little bit more. Frankly speaking, we're not too concerned with what the headline is or why stuff happens. We're a lot more concerned with the chart and the levels. And our base case has always been that most people, whatever way you look at it, are going to be fairly comfortable with crude trading in this, broadly speaking, in the 60 to 50 range. And I'm not going to go through the whole discussion. I've done it many times before. Things could get chickier. People will be very happy to be able to smack this back inside this range and hold it inside this range. So right now we'll have to see what happens, but unless something really drastic happens, we would not expect this to completely crumble. Neither would we expect this to really shoot out of control above those 62s, right? This was where the various attacks happened. So that 62.50 is a pivotal level. If you go back on your weekly chart, you can see it. So that's kind of like the oops, something may happen zone. 55 is kind of all good. The 50 is the Saudis, whatever it takes. So right here, we're kind of hovering here in the middle of this range, waiting for the next catalyst. So I don't really think there's a huge edge in doing anything here either side for now on crude. At least we're not particularly busy inside this zone or inside this range here. Yeah, that's just, it's kind of like a wait and see, because we've got a lot of, we're waiting for all these tech earnings, right? So you just have to be we have to see what happens out of the Fed. We have to see what happens out of the ECB. We have to see what happens with all these, with Amazon, Apple. So it's kind of like market's a little bit stuck in limbo. I mean, what we do know clearly is that we are extended right now. Whether how that plays out, we'll have to see. But clearly, unless we get a headline, right, it doesn't really make sense that you get a huge catalyst, huge positions being taken right here, just ahead of the ECB, just ahead of the FOMC, just ahead of Apple. Chances are we'll stay in limbo. We might grind higher. We'll have very choppy action until we get through this 2-week stretch, right? Normally, as always, we'll always let price guide us, but that's pretty much where we are. Yeah, you want to keep an eye and see what happens on JNK, right? We had a couple of red days. I know that's illegal, but that's clearly something you want to keep your eye out for, especially if that accelerates to the others to the downside. Another chart we think is particularly interesting and you want to focus on are the banks, right? XLF. How's GS doing today? I haven't watched. I mean, actually didn't. Yeah, you see here it's kind of stuck. But again, you see, still not holding too pretty. So you want to keep an eye on these things, right? Keep an eye on the banks. Keep an eye on stocks. Keep an eye on high yield, and just to get a feel, right? But clearly, the way things have been trading, right? gold still catching bid. You see how silver recovered. You've got bonds still staying bid. Everything is pointing to the fact that, we should be getting some kind of a correction. The biggest mistake people tend to do is look at all these signs and say, oh, the correction has to happen now, and they go all in, right? And the problem is they keep on chasing it or adding to the position that they get so far offside that even though sooner or later we get that 5 to 10% correction, that 10% is not even to get them back to BE, right? So what's important is to understand the context, understand that things are extended, but find the best ways of expressing the trade and to not stubbornly fight flows, right? To not stubbornly fight the tape, because it has never worked. And if anything, the last 10 years have been an exemplary show of why you shouldn't be doing that, right? So pick your levels, pick your spots, and and let's see what happens. But again, I think the most interesting dynamic here is still, to continue to try and focus on those bonds, right? I still think, and we post this on the blog too, these longs on the bonds and the long on BND we have on makes sense, especially in the context of a possible correction. I know some people will argue that, and we wouldn't be surprised to get a situation where it's sell everything if there's a liquidity event, right? You both get an unwind of the bonds and stocks. But normally, the even in some kind of a less drastic liquidity event, the bonds will continue to catch a bid. So to us, rather than being stubbornly short ES or NASDAQ, it makes sense on the indices to try and short Russell, or here in this case, you can, because of what's going on in China, because of what's going on with Boeing, if you have to short something, it makes sense to stay short or focus more on the Dow, because they're likely to stay a little bit more heavy. And on the other side, or to, express that views by continuing to hold that long bond exposure, right? And as we've been saying on Twitter, right, all these weekends, we're going into all these weekends, albeit not huge exposure, but we're definitely not going into the weekends gung-ho with risk-on positions. We'd much rather go into the weekends with some kind of defensive play and risk-off positions, okay? Good stuff, guys. Look, we've been going for over 20 minutes. I'll call it a day here because I want to upload it to YouTube sooner or later. If not, it takes a little bit too much time. Thanks for joining. Send me an email. Let me know if you enjoyed this. I'll try and do this a little bit more often if people are interested, okay? Guys, have an awesome one. Thank you so much for flying with 50. Have a great one, and all the best. Take care. Bye-bye.